Welcome back to Talk Tickers, the show for the experienced investor, where we strip away the fluff, ignore the corporate PR spin, and get straight to the numbers that actually matter.
That's right. No jargon without a translation, and definitely no mercy for bad capital allocation.
Today is Tuesday, January 20, 2026. We are breaking down the Q4 2025 print from KeyCorp, ticker symbol KEY. And look, I'm going to be honest right out of the gate. This tape is ugly.
It is not pretty.
We have a company that posted a double beat on the top and bottom lines. They raised guidance. They promised to buy back a massive amount of stock. And the market's reaction.
Big thumbs down.
They took the stock out back and shot it. Shares are down about 2.3% pre-market, chopping around the low $20 range.
It's the classic good news is bad news setup. Or, maybe more accurately, the market is looking at a stock that's run up 20% in the last year and asking, is this as good as it gets?
That is exactly the mission today. We need to figure out if the algorithm is broken or if the market smells a rat. Is this just a sell the news event on a crowded trade? Or is there a structural crack in the guidance that the headline bots missed?
To answer that, we have to look past the EPS beat. I mean, everyone beats EPS these days. That's just game management. The real story here is the engine room net interest income and the balance sheet remix.
Okay, so let's look at the scorecard quickly before we tear it apart.
Yeah.
Adjusted EPS came in at 41 cents.
Beating the consensus of 39 cents.
And GAAP was actually 43 cents, so the quality of earnings was decent. No massive one-time adjustments hiding the truth.
Right. And on the top line,
revenue hit $2.005 billion on a taxable equivalent basis, so, adjusting for their muni portfolio, which handily beat the $1.97 billion consensus. So headline beat, revenue beat.
But here's where the rubber meets the road for a regional bank. Net interest income, or NII. In this rate environment, NII is everything.
And KeyCorp posted NII up 15% year over year to $1.223 billion.
That's a massive jump.
It is. And the net interest margin, the spread they make between what they pay depositors and what they charge borrowers, expanded to 2.82%. That is up 41 basis points from a year ago.
Okay, hold on. 41 basis points of expansion is huge, but I want to understand how they did it. Management keeps using this phrase, balance sheet optimization.
Right.
Usually, when a CEO says optimization, it means they fired a bunch of people and sold the office furniture. But that doesn't drive NIM expansion like this. What is actually happening under the hood?
This is the remix strategy we need to talk about. It's not about cutting costs. It's about aggressively churning the portfolio. Imagine you have a bond portfolio full of bonds paying 1%.
Obviously.
Well, banks are just giant bond funds with branches. KeyCorp is intentionally letting their low-yielding consumer loans run off. Specifically, they called out mortgages to doctors and dentists. Wait, pause there. Doctors and dentists. Those are the best credit risks in the world. They pay their bills. Why would you want to kick them out of the bank?
You're thinking about credit risk? Will they pay me back? But KeyCorp is solving for duration risk and yield. Those doctor loans are yielding, 3.3%?
And in a world where the risk-free rate is substantially higher, 3.3% is dead money.
Exactly. It's a drag. Even if they pay you back, you're losing money in real terms against your opportunity cost. Plus, those mortgages are sticky. They stay on the books for 30 years.
So just letting them fade away.
And taking that capital to lend to commercial clients who are paying floating rates that are much, much higher.
So they are trading safety and duration for yield and rotation.
Correct. It's a swap trade on their own balance sheet. But the remix isn't just on the asset side, it's on the liability side too. This is where I think the real magic, or maybe the real risk, is.
You're talking about the deposits.
Specifically, the hot money. KeyCorp let $2.4 billion of brokered CDs and borrowings run off in Q4 alone.
Okay, for the listener who isn't staring at a Bloomberg terminal, let's clarify. Brokered CDs are basically deposits you buy from a broker, right? You pay top dollar to get the cash.
Exactly. It's mercenary capital. These aren't loyal customers named Grandma Betty who keep their money in a savings account because they like the teller. These are rate shoppers. It's the most expensive slice of the liability stack.
So by kicking them out, you lower your average cost of funds.
Significantly. And management was incredibly aggressive here. They stated they plan to take brokered deposits basically to zero by the middle of 2026.
Zero. That seems risky. I mean, if you drain the liquidity, what happens if there's a run or if loan demand spikes?
That's the skepticism you should have. Their argument is that their core client deposits are sticky enough to handle it. They cited their deposit betas, which is just a measure of how much they have to raise rates to keep customers, are stabilizing in the low 50s.
So they think they have the pricing power to tell the mercenaries to take a hike.
That's the bet. So if the plan works, you dump the 3% mortgages, you dump the expensive brokered CDs, and you're left with high-yield commercial loans funded by cheaper core deposits.
That's the math behind the 2.82% margin.
Precisely. It's financial engineering, but it's the good kind. It's fixing the plumbing.
But let's play devil's advocate. Usually when a regional bank pivots hard to commercial relationship lending, it's code for we're going to take on more credit risk.
Yeah, that's the fear.
How is the loan book actually holding up?
Surprisingly well. Net charge-offs, the actual losses, came in at 39 basis points. That's better than their own target.
Did they flag any sectors? Usually we hear office CRE or multifamily scaring people.
The CRO mentioned consumer discretionary and agriculture as watch lists, but frankly, those are standard boilerplate right now. The non-performing assets and delinquencies are actually trending down. So for now, the credit cliff isn't visible.
Okay, so the engine is running clean. But let's shift to the strategy because this is where the drama happened on the call. Going into this print, the big question hanging over KeyCorp was capital allocation. Specifically, are they going to do something stupid?
The empire-building fear. Always a concern with banks this size.
Right. There's always this pressure on mid-sized banks to get bigger, scale or die. And analysts were terrified KeyCorp was going to announce a merger, which usually means years of headaches and shareholder dilution.
This was the highlight of the Q&A session. Mike Mayo, who, let's be honest, is the closest thing we have to a celebrity in bank analysis because he enjoys making CEOs sweat God on the line.
I love a good Mike Mayo inquisition. What did he ask?
He didn't dance around it. He basically pressed CEO Chris Gorman, are you going to buy bank, yes or no? You could practically hear the tension in the room.
And Gorman.
He was, to quote him directly, unambiguous. He said they are not focused on bank M&A.
That is a hard no.
It's as hard a no as you get in corporate America. He pivoted immediately to organic growth and returning capital, and that pivot is backed up by the checkbook.
The buyback.
$1.2 billion authorized for 2026. They plan to buy back at least $300 million just in Q1.
See, this is what I find so interesting. $1.2 billion is a massive number for them. It puts a synthetic floor under the stock price. It tells me that management thinks their own stock is the best asset they can buy.
It creates a defensive shell. Even if the market hates the sector, that constant bid from the company treasury supports the price.
But, and there's always a but, let's look at the guidance for 2026.
Yeah.
Because while they're buying back stock, they're also guiding for revenue growth of 7% and an II growth of 8 to 10%.
Right, which implies positive operating leverage of 300 to 400 basis points.
Which is fantastic. Growing revenue faster than expenses is the holy grail.
It is.
However, there's a weird disconnect in the numbers that some analysts picked up on. And I think this might be why the stock is down. Let's talk about the sandbagging debate regarding investment banking fees.
Yeah, this was the sticking point. The CFO, Clark Khayat, guided investment banking fees to be up only 5%.
5%. But wait, didn't they just go on a hiring spree?
They did. They increased their frontline staff bankers, wealth managers, by nearly 10%. And these aren't cheap hires. These are managing directors with expensive guarantees.
So walk me through the logic. You increase your fixed cost base by hiring expensive bankers, but you tell the street revenue from that unit is only going up 5%. That just destroys your margin. Why would they do that?
This is where Ibrahim Poonawala and Ryan Nash, two other sharp analysts, really pushed back. They asked, why hire the bodies if you don't see the revenue?
What's the read here? Are they incompetent or are they lying?
I think they're sandbagging. I mean, think about the operating leverage coil they're winding here.
Yeah.
You've added the fixed costs, the people. Those costs are in the run rate now. Okay. If the M&A market thaws even a little bit and those bankers start closing deals, that revenue flows almost pure profit to the bottom line because the cost is already paid for.
So that 5% guidance isn't a target, it's a worst case scenario.
Exactly. Management even admitted they are being conservative. They mentioned that private equity firms, the sponsors, are mostly just trading assets between their own funds right now rather than doing outright sales.
Right, the old fund A sells to fund B trick. No fee for the bank on that.
Correct. But if that changes, if the IPO market opens, if M&A comes back, KeyCorp is sitting on a coiled spring of earnings potential that isn't priced into that 5% guidance.
So the bear case is you hired too many people for no growth. The bull case is you built the army, and when the war starts, you're going to crush it.
And in the meantime, while waiting for the war, you buy back $1.2 billion of your own stock.
Let's pivot to the boardroom because there was a governance update this morning that I think is actually more important than the earnings beat. They announced some new directors.
Yeah, the headline name here is Tony DeSpirito.
For those who don't track board seats like fantasy football stats, who is he?
He's the CIO of fundamental equities at BlackRock.
Okay, stop. You don't bring a BlackRock CIO onto your board to help pick the color of the carpet in the lobby.
No. You brought him in to enforce discipline. This signals a hyper-focus on capital allocation. Having a heavy hitter like that in the boardroom aligns perfectly with the no M&A pledge and the massive buyback. It's adult supervision.
It screams shareholder value. And they also swapped the lead independent director. Sandy Cutler is out of that role, and Todd Vasos is in.
The CEO of Dollar General.
Another operator focused on efficiency and margins.
It's a board built for a grind-it-out environment, not a shoot-for-the-moon growth phase.
One small detail I want to clean up before we get to the trade ideas. There was some noise about commercial real estate fees dropping. I saw some chatter on the terminal that people were spooked by the drop in servicing fees. Is the sky falling?
No, that's a read the footnote situation. Commercial mortgage servicing fees dropped and will stay lower, about 50 to 60 million a quarter. But it's not because the business died. They changed how they handle escrow deposits.
Meaning?
Instead of charging a fee, they are keeping the deposits on the balance sheet. So the fee income line goes down, but the net interest income line goes up.
It's a geography shift.
Totally. It's left pocket versus right pocket.
Yeah.
But if you're an algo reading headlines, you see fees down and you sell. Humans need to look closer.
Last thing, AI. Every CEO has to say it or they lose their bonus. KeyCorp is spending $1 billion on tech. Are we seeing robots?
The CEO was refreshingly honest. He said it's too early for hard efficiency numbers on the bottom line, but he dropped one stat that blew my mind.
No.
A call center call handled by AI costs them 25 cents. A human call costs $9.
25 cents versus $9.
Yeah,
That is the definition of deflationary tech.
It is. But right now, that $1 billion spend is just table stakes to keep the lights on. It's not a profit driver yet. It's a survival tax.
Okay, let's synthesize this. We have a bank that is, 1, shrinking its share count aggressively, 2, remixing its loan book to dump low yield risk, 3, putting adults from BlackRock on the board, and 4, refusing to do risky M&A.
And the market sold it off 2% today.
Which brings us to the fun part.
My favorite part.
It is time for our This Is Not Financial Advice segment. This is where we pitch our wildest, most plausible trade ideas based on what we just heard. Listener, you know the drill. We are just voices in your head. Do your own diligence. Don't sue us if you lose your shirt.
I'm ready.
What is the play?
I call this the boring banker pairs trade.
Okay, lay it out.
I want to go long KeyCorp ticker, KY, and short the regional banking ETF ticker, KRE.
Long the stock we just analyzed, short the sector. Why?
It comes down to discipline versus animal spirits.
Unpack that.
KeyCorp has tied itself to the mast. They said no M&A. They are shrinking the asset base. They are buying back stock. They are essentially a cannibal eating themselves to drive EPS. That creates a floor. It's boring, it's safe, it's defensive.
And the rest of the sector. The KRE.
The rest of the sector is feeling confident again. Rates are stabilizing. The economy is soft landing. That is when regional bank CEOs get dangerous.
You think they're going to go shopping?
I guarantee it. The animal spirits are returning to the KRE index. You're going to see other banks start chasing growth, overpaying for deposits, and worst of all, diluting their shareholders to buy competitors at a premium.
So the trade is long the bank that is shrinking its float, short the banks that are about to dilute their float.
Exactly. You want to own the capital allocator, which is KeyCorp, and bet against the empire builders, which is the index. KeyCorp is the disciplined, boring machine that outperforms the Cowboy Index in 2026.
I love it. It's a relative value play. You don't even need the market to go up. You just need KeyCorp to be smarter than its neighbors.
And with that BlackRock guy on the board, I think the odds are in their favor.
So to wrap this up, KeyCorp beats earnings, beats revenue, promises a mountain of buybacks, and swears off stupid deals. The market sold it down today, likely taking profits after a 20% run.
And if you believe in the durability of that NIM expansion, if you think that remix from doctors to commercial loans holds up, then today's dip is a gift.
And if that sandbagged fee guidance is wrong, and the bankers they just hired actually start closing deals,
then you have a free call option on an M&A boom with a downside floor provided by the buyback.
keep your eyes on the ticker and watch those deposit costs. We'll see you for the next print. This has been Talk Tickers.
See you next time.